It has been an ugly start to the year, to say the least. The Nasdaq in bear market territory, the S&P on its way, it would appear anyways, to bear market territory, obviously down 20% from the highs, about 15% or so right now. Let's talk about, guys, how to protect ourselves in a bear market when it comes to longer term positions. What do we need to know about investing in bear market conditions?
I said over and over again, probably at least 5 times, do not get into position all at once. If you want to buy shares of whatever it might be, and I know he wants some EV names, and that's not what I'm going to bring up here on my chart, but I said do not get in all at once. Right? There's something called dollar cost averaging. Find something you're willing to invest in over time, whether you put something in monthly at the first of the month, the 15th, the 20th, whatever you like, or put it in quarterly, or just 10% here, wait till after earnings, 20% there. This is what I'm talking about, because you're not going to pick the bottom, man. It's just not going to happen. So getting all at once doesn't make any sense. Now, for myself, look, I actually picked up some TD today, and I like TD as a bank, but I just wanted to show you have a name which had been so strong last year and to the beginning of the year, but is pulling back heavily with a lot of the financials. We just broke the 200 period moving average, which can be bearish. Now, this is a point after 2 rounds of earnings, after the Fed rate hike. That's when I'm actually now looking to jump in every single quarter and start evaluating, picking some things up. But do you want to be all in when you're breaking the 200? No. Just take 10% of your position, 20%. And then when it comes a couple of quarters from now or another month, take it again. Or when it hits a key price level, and understand when your time horizon is long enough, ultimately it's not the end of the world, right? Like, these are shares that you want to necessarily hold on to for 5 years, 10 years, 20, 30 years, God willing. Then it's all about not picking the bottom and about being patient and easing your way in.
Yeah, look, for me, bear market, just understand the market. Why is it a bear market? What's causing some of these moves to happen in the bear market, right? I mean, it might not be the right time to go in there and start investing in certain names that you may like, right? A big, huge mistake that happens all the time when we get into these kind of bear markets are people look for the beat down names. So they go in there and they call up a name, like a SoFi or something like that. And they say, oh my God, like what? Watch a daily chart here on SoFi, where we've come from, where we're going. So SoFi was just $13 back in March. But look at this move all the way down, right? The problem is the bear market started like in November, December, when the Fed started, well, I mean, not technically the bear market, but the move down when we started talking about inflation from the Fed. And when that starts to happen, you don't need to be in these names. This is a name that's not making money. There's so many of these names. We talk about them all the time on the show. A Twilio, a SoFi, a BarkBox, any of these, Fisker, a RIVN, anything like that. They may be great companies that you like, but you don't have to go shopping in beat down names, because if you thought, oh my God, look, this name was $23, how could it be wrong when it's cut in half here at 12? We have to buy this. But now it's cut in half again right down here. There's so many names like this. Let's just go and talk about RIVN quickly here, because that's another name. You may like the EV space. Neil just had an example there about his barber, right? So a lot of people, it's an exciting space, and he's not wrong. I think getting into EVs is probably smart for an investment, right? But right now, understand the market that we're in. We are not rewarding. I mean, here's the RIVN chart. We are not, the market, I should say, is not rewarding companies that don't make money. When we're raising rates in an inflation environment, you have to stick with companies that physically make something, right? That don't have to, hold cash, because right now, if you had cash, it was worth 2%. Now it's worth 4%. In the market, right? Just because of the way the market is. The market goes up with interest rates. When interest rates go up, the market tends to go down on some of these names that aren't producing anything. So RIVN today, they need an investment. Well, now your investment's costing you more money, right? Just from time value of money. So what the mistake for me would be when you're looking at bear markets is, a lot of traders go into names that have been chopped in half, but there's still more. The ultimate bottom is 0. So if you're not investing in the right names, you're gonna get chopped. So that's why I like Apple, the Microsoft, even healthcare names that are actually, physically doing something, have customers, have recurring revenues. Apple makes the iPhone, right? Procter & Gamble making products, Eli Lilly, some of the healthcare names, and some of the banks. You can stay away from high valuation tech names. The writing was on the wall for a lot of these names.
if you're going to participate at these levels in these conditions, you have to have an out. Understand that you might just be a little bit early, and whether that is based on some sort of monetary amount, whether that's based on a percent amount, whether that's just simply a technical level that gets broken, guys, make sure you always have an out. The market changed this year. Hope that helps with investing in a bear market condition.